Welcome. I would like to introduce you all to Laurie Barkman. Laurie is the owner and CEO of SmallDotBig and an award-winning Vistage speaker. I had Laurie come to two of my chief executive group meetings back in February to discuss building the value of your company. We had a great conversations, Laurie, and we really enjoyed having you there. And this is an opportunity to both build off of some of what we heard and learned and ask a few more questions, if that sounds good.
Awesome. Thanks, Rick. I'm glad to be with you
Yeah,
again.
yeah, again, good to
Third
be with
time's
you.
a charm.
Absolutely, absolutely. So, Laurie, can you give give the folks a little bit of your background?
Absolutely. As you mentioned in the introduction, my firm is Small Dot Big. So let's start with a fun little story. When you're playing pool with someone from England or Australia, they're playing pool and they're saying small dot or big dot. We're saying solids or stripes. And I took that as an inspiration for what I do with business owners is help them see what they're not seeing. And I work with business owners from transition to transaction, from creating value to letting go. And my story in this exit planning world began when the company I was working with got acquired by a Fortune 50. So I was a CEO for about $100 million division of a company that got acquired with an amazing experience around that. And it struck me how entrepreneurs, they don't build their business on their own. Why should they sell their company on their own? Shouldn't they surround themselves with trusted advisors? And I want to be one of those people. So I got my certification as a mergers and acquisitions advisor. So in addition to working with business owners to get ready for an ultimate exit, I also work with them on the transaction to make sure that we're seeing everything through from A to Z.
Wonderful. Great, great, great. Thank you. Laurie, you kicked off our workshop back in February with a wonderful slide. If I remember it right, it said the one thing we know is that 100% of us will be exiting our business someday. And, we all have a strategic plan for running our business, yet few have a strategic transition plan for exiting our business. And that really caught the eye of our folks. Can you say more and tell us about strategic transition planning?
Absolutely. Just like you said, you're going to create a business plan. You're going to get your management team aligned and you're going to execute. That's the point of having a strategic plan. And there's been studies shown if we write down our goals, if we write down what we aim to do, we're more than 40% on our way, right? We're more than 40% more likely to achieve just because we've said we want to do these things. So if we have these lofty aspirations to sell our company one day or have our management team buy it from us or transition it to our kids, and we think about it and we think about it, but we don't put a plan together, what happens? I just met with a business owner yesterday and he laughed at himself a little bit. He said, "Yeah, my plan is to sell my business in 3 to 5 years." And my wife reminded me that I said that 8 years ago. And so we laughed about it and he said, I really think I want to do this. I have to get it out of my head. It's
Sure.
swirling in my head. I have all these questions. And I said, my superpower has been strategic planning for a long time. But as I mentioned, I was a CEO. Before that, I worked in big companies, small companies, everything in between. And finding structure to something that's complicated or finding structure to something where you don't have experience with it. It seems so ambiguous that it's just too easy to put on the back burner. I have another client who has been wanting to update his operating agreement with his business partner for probably the last 6 years. He told me that it's sitting on his desk in the corner and it's got coffee stains on it and he looks at it every once in a while and now it's like the bane of his existence. He can't stand looking at it anymore. So what I do is I work with clients to help them get clarity around the biggest questions swirling in their mind and sitting on their shoulders. And so what we do is over a period of time, this is not overnight, this is not an easy thing to do, but we work on a series of pieces and parts that over time stitches together a strategic business transition plan. And it starts with just like your business plan should. What are your goals?
Right.
What are you trying to accomplish? What's your vision
Yeah.
for a transition and why? Why do these things matter to you? What are those goals? Let's try to quantify some of those things. I like to put the goals, if we can, in 3 buckets. The first bucket being a personal goal. The second one is financial. And of course, business is tied in, but we're talking about the financial aspects of a sale or transition. And then the third is the business. And so the business, what goals do we have for it? And what do we need to do to get from here to there? That's at a high level what we're looking to accomplish. And a plan is only as good as its execution. So if we only set the goals, but we don't get to strategies or action plans, and we don't get to articulate who is accountable for what and by when, this plan's going nowhere. So the process is to work with the owner and help hold a level of accountability to them so that at the right time, they can be pulling in the resources they need to get the plan moving forward.
No, that's great. I know one of the powerful tools that we used in the workshop. You had all of our members take a business readiness assessment, and as I recall, it provided a score on how ready they were to sell their business around 8 key drivers of the company value. So it's a really great litmus test on how ready is your company to sell today, and then what needs to be done to move forward. What's been your experience in how best to prepare CEOs to sell the business, the time it takes? How do you go about going from hearing the score to, okay, I am ready?
It can vary for people. For some people, they're more ready than others. They've been thinking about it for a while. They just need to get to the starting block. For others, they're thinking, well, I need to do certain things first. So we have to figure out what are those things. One of those things might be to improve the business, especially after COVID. Some folks had a little bit of a COVID hangover on their financials, and they want to get 1 more year, 2 years, 3 years of improved profitability so that when there's a multiplier on that number, it's the best it can be. And there's a trajectory that's trusted. So that's part of it, is how do we make sure that whoever's looking at your business identifies the opportunities and the upside and sees minimal risk, right? We're trying to minimize risk in a transaction on both sides. And for a buyer, ultimately it influences the price they're willing to pay. So for a seller who wants to get ready, there's a lot of different aspects of getting ready. That's why the personal side of this is important, because it could just be the mental blocker of, oh, this was my grandfather's company and I'm the generation to sell it. And there's an emotion tied to that. So there's potentially some baggage there getting in the way. For others, it's about getting the folks who are going to stay with the business incentivized and excited about a transition, maybe including them in the process so that the buyer sees continuity, and again, might be willing to pay more for that or less if the management team isn't staying. So those are all really key aspects. I mean, there's a really long laundry list here, Rick, but I think the main things is understanding what comprises value in your business is a great place to start. If you've not had a valuation done recently or at all, I love doing that with my clients because it really is very eye-opening. And likewise, when I talked about the financial goals, we also talk about their financial situation and what we might need that net number to be if you sold the company to someone, right? Regardless of who that is, you're selling it. There's a transaction there, and there's the tax man coming a calling. And so there's a slice that's going to the government, and there's a slice that's going maybe to pay off debt. So we have this net number. What is that number? And for some, there's a gap. We need to know what that gap is. And if we say, wow, we've got 5 years to close a $10 million gap, how do we do that?
Right.
The more time that's on your side,
Yeah.
the more options you can create and the more ability you have to have a successful transition with what your goals are. If you say, well, I'm okay with that net number and I just need to sell next year because of health issues or because of disputes in the business, well, that might affect your selling price, and that's okay. We need to understand that. But that just might be the way it is. Some people say, I need to do this. I'm tired or I'm burned out, or other dynamics that are putting extenuating circumstances on the business and a business owner, and they're ready for their next part of their life.
Right. Wow. No, very helpful. It is, I love your whole concept of that integration of the personal and the business, and we'll dig into that a little bit. I've got some questions for you about that. One thing that you presented to the group that I think really struck a chord with people was the notion of an organizational life cycle, or I know some of my folks were referring to it as a maturity curve. And the question was, how does a company know where they are on this maturity curve? Is there an assessment or something like that that you can do? And the second part of that is, how does the life cycle impact, or where you are on this maturity curve impact the business value?
Yeah, the life cycle is thinking about companies like we're people, and that a company, just like people, we go through different
Right,
stages.
right, right,
And it starts as infants. We crawl, walk, run, and we have a courtship period. We find partners. We might get divorced from partners.
right,
We continue to grow, and we have challenges along the way. So, a stage for a company, very common in the groups in Vistage, are adolescents, because these are not typically startups, right? Vistage members are of a certain size and maturity. And so, typically in our groups, we're seeing adolescence. So let's put an age factor of maybe 5 to 10 years of age around those types of companies, just for sake of conversation. Um, a company that is maturing to the next stage is approaching a stage that's a wonderful place to be, which is called prime. And prime is not our peak on the chart. If you look at the chart, it looks like a roller coaster.
right.
What's at the top of the chart is actually called the fall. The fall is the start of the downside, the
Yeah,
death valley, if you will. It's this other side of the chart. The decline is the side of the curve where we don't want to be. And for some companies, it is very, very mature businesses that just perhaps are past their prime, if I could say it that way. Maybe they have cash cow businesses that on paper, on the surface, are covering up real issues in the business because financials are still good. However, they've been on a decline for a while. Perhaps businesses in decline are more inward focused, and there's a lot of infighting. There's certain signals. So how can a business know where they are? Well, there's some resources out there that can help us understand where we are in our organizational life cycle. But at a high level, these are some of the characteristics. Let me go back to prime for a second, because this is really, I think, what intrigued a lot of companies in the room. When we think about a company that's in prime, a prime company is hitting on all cylinders.
right,
Product market fit,
right,
financials are good. We've
right.
articulated our mission, vision, values, and our purpose, and employees are walking the talk. Management is walking the talk. And some reasons why a company might head towards the fall could be that they've been disintermediated by technology, corporate competition has heated up, or some regulatory issues have caused problems. For some companies after COVID, they just didn't recover. So the fall is for sure about financial, but a lot of it is about culture.
Yeah,
So you might ask, Rick, and I think this came up in the group, can a company be in more than one category? And can we change from one to the other?
right, right.
Um, and so it is possible to go from the decline back to a maturity cycle that looks healthier. Sure, that is possible. And I'm an advocate of growth and innovation strategies that can help a company do that. One thing to mention in my introduction is I'm an adjunct professor of entrepreneurship at Carnegie Mellon University, and I teach a class called Corporate Startups, and it's about corporate entrepreneurship and how big companies, it's not too late. and that they can be investing in innovation and they can think differently about growth, organic growth, and what they can be doing. I'm also an advocate for growth through acquisition. And that's another way for companies to think differently about, bringing them balance sheet and bringing their financial picture into a healthier, sustainable future. So the organizational life cycle is not an exact science to pinpoint where you are. I think it's great framework to start the conversation, especially in a workshop like Vistage when we have a room full of folks that are all at different vantage points. It was a way to level set, I think, and for people to understand each other also, and in a different context.
Great. No, very, very helpful. Thank you. No, that's really great. Um, Another thing that you mentioned in the with the groups, both groups, that was very helpful, and it's probably common language in the world of M&A, but I know for some of our folks it was new language, and that was really looking at the kind of sale that one might consider. You spoke about strategic, you spoke about financial, and I forget the name of the third, but what I remember is it's kind of an internal transfer, either an ESOP or a family generational kind of a thing, or you've got a mentor that you'd like to see take over the business. So typically three different kinds of potential sales. Could you talk a little bit about those three types of acquisitions?
Sure. It's in the context of this big question of who should own your business after you.
Yeah, yeah,
And we talked about these three potential buyer segments. So at a high level, I'll share a little bit more. The first one, like you said, Rick, is strategic, a strategic buyer. And what are some characteristics of a strategic buyer? Well, a strategic buyer is a company or an entity. Maybe it's a competitor to you. Maybe it's a company that's in your ecosystem, upstream, downstream supply chain. Maybe they're a customer. So this is an entity that is looking to incorporate the assets of your business into their business.
right.
It was like my experience, a big company eating a smaller company. That's the most common, right? We all can sort of picture that. And what happens a lot of times is they will run that division or that company as a standalone entity initially, and then eventually they'll integrate it in. So when a strategic buyer is thinking about its financials and how to value that acquisition, they may say, well, we don't necessarily need these functions and these people and this headcount expense. So over time, we're going to get leverage in this sale, in this transaction, because of these changes we're going to make to the business. And it may also enhance our ability to cross-sell or upsell, explore new markets. And so they may have an upside on the top line as well as an improvement on expenses. And so that enhances the bottom line. Now, we don't see their numbers and we don't know ultimately what they're willing to pay. But generally speaking, strategics tend to pay a premium because they can see a benefit in a different way than these other categories.
And
So this next
an easier savings point.
could
An
be, yeah.
point.
And how they're doing their fancy math, which I won't bore everybody with, that all the MBA speak on net present value and IRR and all these calculations they're going to do.
Yeah.
So then the next category of potential buyers are financial buyers. Now, of course, they're doing fancy math also. These are institutional buyers that are most commonly in the news. We hear about private equity groups that are doing acquisitions. And what private equity groups do is they have limited partners that are doing private placement investments, and they will acquire standalone entities and run them as a standalone. And that's normally a platform deal. So these are larger acquisitions, or they might do smaller deals and then tuck them in underneath, which are, again, tuck-ins or add-ons. So a private equity buyer that's doing what we really might think of as a hybrid, where it has some of the attributes of a strategic, where we want the pieces and parts and we want to integrate it in and we're going to get cost leverage, then they might be willing to pay a little bit more as a premium for these tuck-ins. A platform deal They're looking for predictability of future cash flow. They're looking for it to stand alone on its own. It's very important for the management team to stay in place because they need it to run as it's been running. Other common things you might hear about or not hear about. Another one we talked about in our sessions were family offices. That family offices are significant investors in our country, but we're kind of below the radar. We don't really know a lot about them, but they're emerging as an investor group because they have a long-term time horizon, which differentiates them from private equity groups. Family office is a group of investors. They're all related to each other, and their time horizon typically is infinite. They're looking to continue to generate positive cash flow, positive returns for their family, and the investments they make are buy and hold typically, whereas a private equity group might have a 5 to 7 year time horizon because they want to get a return on their investment for their investor group. But related to that, as a seller, it can create a special financial opportunity, what we call the second bite of the apple. So if you're acquired by a private equity group and they give you an opportunity to roll over some of your equity interests into the larger portfolio, and then that portfolio is going to have an exit, you could see a significant return on investment as you participate in that growth cycle. So that's a very interesting thing. It's just like with any of these potential buyers, we have to find the right fit. So I'm not giving any judgment about it. I'm just sharing some opportunity to think about and frame it out.
On that private equity, a few of my folks are looking at that, and what's interesting is they get a nice payout by selling the company. Sometimes they'll be asked to come run the company or work for the private equity group or not. But oftentimes they're asked, part of the deal is we need you to keep 10% or 20% of that equity in the ongoing operation. And the irony is when the next bite of the apple comes along 5, 6 years later, they get virtually as much money, if not possibly more, than what they did on the initial sale. Is that typical?
Yeah, it can be typical, absolutely, because of that strategy for private equity groups to have a pretty short, 5 to 7 years is not a long time horizon, relatively speaking.
Yeah.
And there's a lot of impetus to grow and to improve operations and improve profitability. And then especially if it's part of a roll-up.
Yeah.
I was working with on a buy side, I was working with a private equity group doing a roll-up, and I helped them and do some sourcing and find some deals.
Yeah.
And that was absolutely something that our sellers were open to, excited about. They had a lot of gas in the tank, and they were motivated, incentivized to stay and be part of that bigger picture.
Yeah, great. So what's the third category? What do you
The
call
third
it?
category is related buyers, and they may literally be related to you because they're family. Again, the question is who should own your business after you? So are we going to gift our shares? Are we going to sell our shares to family? Are we going to do that with our management team? Some people think that they have a management team that could be future owners of the business. There's a lot of assumptions around both family and management, and I encourage conversations because a lot of times the bubbles are burst that one way or another, these folks may not be a fit, and it's best to figure that out before it's too late. If you're assuming that your junior wants to take it over and junior absolutely does not want it, you really should know that. You should know that before you make all your assumptions and all your plans around junior taking over the business. And likewise for management, very often for management, and it can be for junior also, that they don't have the skill set. So not only do they not have the interest, or they might not have the skill set, they might not have the aptitude, which could obviously be an issue for a future sustainability of the business remaining viable, but also for the management team, non-family, how motivated are they going to be to stay on, and also for the bankability of the business if it starts to really take a downturn headed into the decline. That's not a fun place to be.
It has to be heartbreaking for a first or second generation owner who's really built a great business to speak to a son or daughter or niece or nephew and with this incredible opportunity, and the response is, thank you, but I'm really not interested. And yet, how many may proceed and really not have their heart and soul in it, but it's out of a sense of obligation. So to really have those open and candid conversations, I can imagine is really important for the related segments.
Yeah, absolutely.
Yeah. Wow. Well, as we think about conducting a business readiness assessment, against those 8 key levers, and winding that into a strategic transition plan for the business, 2 critical steps to get ready for a potential sale or exit from the business. What about? I'd like to circle back to the person, to that CEO or business owner themselves. So is there a similar kind of a personal readiness assessment or a personal transition plan that you've done with people, Laura?
Yeah, absolutely. It's really valuable to do this. I like starting here with my clients. I
Okay.
like to start with the personal assessment because the questions bring out things that they probably haven't shared before or articulated before. I have a client that's a husband and wife, and it's just refreshing to have them together in the same room. I'm not saying everyone has to do that, but I think that's a really important dynamic. If, let's say, you are in an ownership with another person, how you feel, how they feel. So if you're with if you have a business partner, I would advocate for both partners taking this assessment and then comparing how they feel about things. This is something called the pre-score, which is a personal readiness to exit. And there's 4 dimensions that the answers are trying to cluster around. The first one is future vision. How do we think about the future? Do we have a perspective of what we want to be doing when we're not working in our business day to day?
Okay.
For many people, the answer is no. They don't know. So
Right.
I had one. I had one client on a 0 to 100. He scored a 0.
Yeah.
He literally scored a 0, and it was not a good situation for him. He said, "Oh my goodness, Laurie, I'm glad I'm working with you."
Well, I know for a number of my folks who are, in the mid to late 50s, 60s, and they're asking that question. One of the things that I read quite a bit about is that next phase of life is really key. Meaning making essentially is at the heart of much of it, and be clear that you want to do something. It may be a volunteer work, it may be golf, but be really clear that whatever it is you're going to be moving on to is giving that meaning making back to you. And people just seem to be living a life that thrives if they have that, versus one of, hmm, you know, sometimes not so happy.
Well,
If
say it. Go ahead and say it. Regret.
Yeah,
And that
regret and
is,
depression, frankly.
and depression. It's common. It's
Yeah,
unfortunately very common.
yeah.
One of the other drivers, like I said, there's 4, and one of the other drivers is personal detachment.
Ah,
And
okay.
the ability to detach, the ability to have an identity outside of your business. What
Yeah,
if your name is on the door? What if you're a
right.
second gen, third gen? How can you detach? I have a podcast called Succession Stories, and one of the guests on the show talked about the sale of the bleach company that had been in the family for 4 generations, like a product that you would get in the grocery store,
Right.
bleach. And he said he can't walk down the bleach aisle. He cannot walk down the household cleaners aisle. He just can't do it. He can't see the product on the shelf knowing that he's not part of that company anymore.
Yeah,
That's
yeah,
personal,
yeah, that is personal. Yeah,
right?
that has to be
So,
tough.
yeah, that's a tough one. And then the other drivers that with this survey brings out, one is around flexibility, how flexible we are in thinking about our transition and what that might mean
Mhm.
with who might own us next, right? So this concept of um, the transaction itself and how we think about it and what our role might be in that new company or that new entity. Do we want to stay on? Do we not want to stay on? Are we open to these things? So understanding flexibility around that. And then last but not least is a category of your team and how involved your team is or will be. For some is important when the time is right, because there can be feelings of guilt around who's left behind, right? And maybe some of them had a nice financial bogey and were incentivized to help out with a transaction in some way. So these questions are geared towards that, towards thinking about who we want to thank along the way and how we want to leave our legacy.
It's just amazing. As with a merger and acquisition, right? What typically makes for an unsuccessful merger and acquisition? It's usually not the lack of financial due diligence or market due diligence or customer due diligence. It's culture stuff. And here we are in the same thing. I mean, those four elements, none of them were about the dollars. It's about really, where is our headspace? Where is our personal readiness for making these kind of transitions? So really, really important. Thank you for sharing all that. Hey, I understand you've got a new book coming out, the Business Transition Handbook. So tell us about it. And it's coming out in May, I believe.
Yeah, I'm super excited about it, Rick. I've had some early readers review it, and they say it's really impactful. They wish they had it when they were going through their entrepreneurial journey. I've written the book so that it's a couple of things. It's storytelling meets educational and learning meets practical.
Right.
What as a handbook. That's why I was very purposeful calling it the Business Transition Handbook. So it's not a workbook where you're going to get it and it's 20 pages. It's pretty beefy, but there's a lot there, and there's a lot to relate to. Again, tried to bring out some stories from folks that have been on my podcast and some anonymized client experiences. And I think these stories can help people realize they're not alone.
Yeah.
And that this is, again, a challenging thing to do. I recognize that you might want to have somebody with you on your journey. And so this is a book that I envision people are going to dog ear and write in and circle and highlight and put post-it notes. I would love that. And I would love for people to read it and say one day back to me how it helped them. And of course, perhaps want to work with me too. That's part of the book is I want people to connect with me, and I hope that it's resonating with them. I just like the podcast. People tell me all the time, oh, they listened to this episode or that episode and they learned this and they learned that. And that's what I want this book to do. If you remember back to my introduction of the name of my firm, and I had that aha moment of, wow, solids and stripes versus small dot and big dot. I'll never see it the same way again. I learned something new. I had a different perspective. And that's my goal with this book.
Yeah. Oh, wonderful. Well, so what is the best way for people to get a hold of you?
Well, LinkedIn is fantastic. I love LinkedIn. Please connect with me there. Message me privately, or connect with me. I'm happy to do that. My email to give that out is lbarkman@smalldotbig.com, and the website is small.big.com.
Awesome. Well, Laurie, thank you so much for taking time today, and great follow-up to our 2 days of workshops. And I'm sure we're going to have a few of our members here wanting to follow up with the personal assessment. So thank you again.
Absolutely. I welcome it. Thanks so much, Rick. It was great to be with you.
Okay.